Okay, today we are going to talk about fiscal policy. Now, fiscal policy is nothing but a consolidated review of government spending and government taxes, which means income and government expenses, all the activities related to it. So, this is fiscal policy. Fiscal policy is nothing but the account of activities which include government expenses and government earnings in form of taxation. There are a few terms which are related to fiscal policy. One is fiscal deficit. Deficit, you know, is deficiency. So basically it is nothing but expenses of the government minus all the earnings of the government. Now, earnings of the government can be revenue receipts, which means all the money through various sources that the government earns, plus capital receipts. Capital receipts is something which the government earn from a one-time sale. Like suppose government is auctioning 3G spectrum, so it will earn one-time money, that is called capital receipt. Revenue receipt is like something like sales tax, income tax, so it is a recurring, every year on year it will come. So one thing is, this capital receipt does not involve the borrowing of the government. So suppose government take a loan of $5 billion from World Health Organization, so it is also a kind of capital receipt, but it will not be included in this particular thing. So fiscal deficit is nothing but earning minus expenses. Why this is important, why we want to capture fiscal deficit in a separate way, is because this is the amount of money which the government is falling short to run the country. For example, just consider India as a house, and you have expenses, you have earnings. So if expenses is more than the earnings, then every month on month you will be borrowing money to meet your expenses, which is not good. So fiscal deficit is not good. Now another term is government receipts. Government receipts, it's nothing but a fancy term for all income of government during an accounting year. Okay. The third important word is nostro account. Nostro account is a very simple account. It's also called as foreign exchange account. Now, foreign exchange account, basically, suppose a lot of currency transaction happens. So all those people who indulge themselves in currency transaction, which means suppose there is a company which changes Indian rupees into dollars or yuan or any other currency, so they will have this nostro account, which is also called as foreign exchange account. So these are held by foreign exchange dealers. Okay. So now there is another important term which is called as primary deficit. Now again, primary deficit is nothing but physical deficit plus interest payments. Now as I told you, like say India has borrowed $100 billion from World Bank, so it cannot pay the entire $100 billion in 1 year, but every year on year it has to pay the interest. So that interest, whatever the interest the government has to pay, plus the physical deficit, this both is a kind of deficit, and they both add up to what is called as primary deficit. So primary deficit is the total amount of money which is deficit in a particular government. So I hope this is clear. Fiscal policy, in which we are talking about all the expenses and taxes taxation, that is income activities of the government. Then we discuss fiscal deficit. This is one of the most key terms. Then government receipts. Then we have talked about nostro account and primary deficit. Now another very key area where questions are asked is appreciation and depreciation of rupee. Appreciation and depreciation of rupee. Now it's a very simple concept. Suppose $1 today is equal to 50 rupees. Okay. Now if $1 becomes equivalent to 75 rupees, which means that value of rupee is declining, so rupee becomes depreciated, which means as you compare it with US dollar, rupee is getting cheaper, right? It is decreasing. Similarly, if $1 is equal to 25 rupees, then it is appreciated. The value of rupee is appreciated. Now basically we know that for this appreciation or depreciation, basically we are considering against some foreign currency. Now how does appreciation or depreciation impact the economy of a country? Now we know for internal economy nothing changes. I mean, this is only when we transact in foreign currency. So what essentially is affected by appreciation and depreciation is imports and exports. Now imports and exports. Now let's talk about import first. Now what happens? Suppose rupees has depreciated, so each dollar is equal to 75 rupees. So suppose earlier you want to get something for $100 from America. Suppose you want to buy a laptop from America which is costing $100. So earlier it was costing you 50,000 rupees because 5,000 rupees for $100. Now again it will be 75 into 100, that is 7,500 rupees, right? So you are paying more. So imports become costlier. Opposite will happen to when the currency is appreciated. When currency is appreciated, imports will become cheaper, right? Now for exports, again opposite happens. If here it is costlier, here again it will be costlier. So if and here it will be cheaper. So when rupee is depreciating, imports become costlier and exports become cheaper. So when rupee is depreciating, which means its value is reducing, whenever you are bringing a laptop, you will be paying more money. And suppose you are a software company and you are giving your services in US, then you will get more money. So export becomes costlier, so you get more money. I hope I have cleared this. So depreciating rupee favors export. So if the rupee is depreciating, so suppose you are charging your client $100 per hour, and if the rupee is depreciating, suddenly for the same $100 you will get 7,500 rupees. So a depreciating rupee favors export and does not favor imports, and that is why China always keeps its currency in a depreciation mode. This is very important. The example of China keeps its currency in depreciation mode. Let's move to the now there are certain factors which actually decide the appreciation and depreciation of rupees. Let's look at that. Now let's look at the factors affecting rupee value. Okay, now remember a general funda that the economy is doing well, then rupee will become better. So rupee will appreciate. Okay, and the vice versa. If economy is not doing well, the rupee will depreciate. Now, what are the factors which affect employment? Employment means if more people are employed, rupee will appreciate. If less people are employed, if there is a lot of unemployment, rupee will depreciate. Second is economic growth. Higher economic growth means rupee will appreciate. Lower economic growth means rupee will depreciate. Second is balance of trade. Balance of trade is another word which is exports minus imports. So if your exports is greater than your imports, which means you are exporting more product than importing products from outside, so balance of trade is positive then, and so rupee will appreciate. But if you are importing more, which means you are producing less in your own country and exporting less, the balance of trade will be negative, and then rupee will depreciate, right? Also, there is something in terms of money supply. Money supply. What happens if money supply is increased in the market? If money supply is increased, suddenly there will be more rupee in the market and the value of rupee will depreciate. So if money supply is increased, so another example would be interest rate. Suppose interest rate is decreased. You know that if interest rate is decreased, more people will borrow money, so again money supply will be increased, and this will lead to depreciation of rupees. So, but always remember this funda: economic doing well, rupee will appreciate. Okay. Now, another important concept is of national income. Now, here you have to national income, which means suppose house, a country as a house, so and it consists of 4 members. So what is the combined income of all the 4 members? That is the national income. Now if I have to define it, it will be the monetary value of all the goods and services provided in a given time period. That is national income in simple terms. Now there are 2 terms. One is GDP, that is, and one is GNP. GDP is gross domestic product, and this is gross national product. Now let's take, now as you know, domestic and national, the difference is of boundaries. So gross domestic product is about all the goods and services within the boundary of the country. So suppose like a Indian company, Infosys, opens up a branch in America, and in there it is earning $100 million a year. So that $100 million, because it is earned outside India, it will not be a part of GDP, but it will be a part of GNP, national product. Similarly, suppose a student goes to US and it is earning, a software professional goes to US and working in a US company, and it's sending every month 1 lakh rupees. So that 1 lakh rupees will not be a part of GDP, but it will be a part of GNP. So GNP is nothing but GDP, which means all the production which is happening inside the country, gross domestic product, plus net NR, that is net income from remittance. Right? Remittance is whatever money Indians send back to their country in any form. Maybe it is in a form of earning from a company, or maybe in form of salary. Right? So this is. Then there is also a concept of GDP per capita, which means GDP divided by population of the country, which means that what is the earning per person, okay, of GDP. Now it is not a very good parameter because it does not account for difference in income distribution. Okay, so Ambani is earning 500 crores a year and someone is earning 500 rupees per month or 1000 rupees per year. So GDP per capita does not account for that. So it's not a very good indicator. But yes, GDP and GNP are good indicators for the economic growth of a country. There is also two terms I will talk about, is real GDP and nominal GDP. Now basically, suppose let's talk an example of products of goods and services. Suppose in year 2000 you used to work, any software professional used to work for $10 an hour. The same software professional today is working for $15 an hour in 2015. So if you see the GDP based on the real value, right, is increased. That is the real GDP. So I'll give example 2000 here and 2015. Here that software professional was working $10 per US and here it is $15. So can we say that GDP in 2015 is higher than 2010? Yes, it will be. The real GDP will be higher. But can we compare the year 2000 GDP with 2015? No, because there has been inflation and the price increase from $10 to $15 may be just accounted for inflation. So there comes the concept of GDP, nominal GDP, which means that we discount whatever the GDP is by inflation. We discount it for inflation, and so we discount this for inflation and we get the nominal GDP, right? So and then we can compare. Suppose the nominal GDP is $8 here and the nominal GDP is $9 here. Then we can say this, yes, in 2015 the economic productivity or the country's GDP has risen as compared to in 2000. If it is 8 here and $7 here after getting the nominal GDP. So nominal GDP is just to compare the real GDP, the GDP of each year. So there is another formula which is called as GDP deflator. GDP deflator, which means real GDP. Real GDP means true GDP divided by nominal GDP. So and basically it accounts for all the inflation. So GDP deflator is that. Now there would be so how do we measure national income? Maybe it be GDP, GNP. There are three methods. One is income method. So whatever the income in any part, in any form, may it be good, may it be services, we simply add all those things and we get the GNP or GDP. Second is the expenditure method. In an economy, the income is equal to the expenditure. Suppose let me give you an example. It's not a house where the income may not be equal to the expenditure. Let's say that in an economy, even if someone is spending, someone is saving something, then also they will deposit it in the bank, and then bank will further give it to some other person who will further invest in a house. So when you see country as a whole, the income is equal to the expenses, right? So if we calculate, if we just add on all the expenses, again we can get the national income. And the third part is value added method. Value added method is if we just see that what is the value added on each of the product and services at each stage, and if we have a sum of it, we will get the national income. Now there can be a complete huge discussion around the method of but I have just mentioned the name and a basic way how it is done. So in income method, we add income of every you know, goods and services in the country, we get the national income. In expenditure method, we just add all the expenses and we get the national income. In value added method, we see that what is the value added at each step, and we get the here. So let's move to the next topic, and that would be BRICS nation. Now it's a very, what does BRICS stand for? BRICS is an acronym for Brazil, Russia, India, China, and South Africa. So these are the countries. Why these countries are important? Because they consist of 40% of the world population and 20% of the global GDP, which means they contribute to a lot of economic activity, but still they are marginalized, which means in a global platform they has these 5 countries have very less say. They are not able to kind of influence the global decisions when it comes to global money or whatever. So these countries met at the 6th summit of at Brazil, 6th summit of BRIC nations in Brazil, and they proposed a BRICS bank, which means that they will form their own bank so that they don't have to depend upon the global banks, which are mostly controlled by US or UK or other European countries. Now this bank, a certain important feature, their headquarter will be in Shanghai, China. Also the main objective, if I have to say, is to counter Western dominance in global finance, plus also provide finance for BRICS nation. So they form a bank for themselves, and among themselves they will use this particular facility. So certain, I don't know if it will be asked, but the subscribed capital is $50 billion, and authorized, which means that everyone has deposited $50 billion, and authorized capital, how much everyone can take out from the bank, is $100 billion. So 5 countries to $50 billion, everyone will it will come together, and anyone at a need of time can take $100 billion. So each country has equal standing. This is very important. In BRICS bank, each country has equal standing. The first president will be from India, and he will be for 6 years, then followed by Brazil, followed by Russia, and so on for 5 years each. So this already has been decided that the first president will be from India for 6 years, next for Brazil, next for Russia, maybe next from China, and next from South Africa. So this is about BRICS nation. Now here is a sheet which I have attached for for your final revision. These are budgets because questions can be asked. Now non-plan expenditure estimate for financial year is estimated. The non-plan expenditure is when government plans expenditure. There is something called planned expenditure, like say there is already a project or there is already a subsidy program for which the already government has planned. But suppose there is something which, suppose a flood comes, and these are non-planned expenditures. So the non-planned expenditure is this many crores. The planned expenditure is this much. Total expenditure is this many crores. If such kind of data is asked, you can see the previous year question and then you can learn. So the requirement for expenditure on defense, internal security, and other necessary expenditure are adequately provided. Now here you see this is the total gross tax receipt from the government. So all this data is there, and this has been taken from the main government site. Key achievement of last year is financial inclusion. 12.5 crores family financially mainstreamed in 100 days because of the Jan Dhan Yojana. Now, transport Swachh Bharat program, game-changing reform like goods and service tax. Now, goods and service tax, I'll just tell you something about that. Basically, currently what happens, there is a different tax for goods and there is a different tax for services. Services, there is an all India tax. So if there is a service tax, it will be same in Chennai, Delhi, Bihar. But goods, there is a different tax. So there is a suppose the same Maruti car, that different tax will be in Jharkhand, Bihar, UP, so all the different places. So what the companies have started doing is they will bill the products, or they will procure the products in the name of the place which has lowest tax. So suppose Jharkhand has the lowest tax for cars, so most of the car will be billed in Jharkhand in the name. So Jharkhand government will get a lot of tax, but other state government will be losing on taxes, right? So especially for an online business, this can be very, very crucial. So government now is thinking that remove this separate service tax, separate good tax, and make it and replace it with a single goods and service tax. Okay. Jan Dhan Yojana, economy 7.4% GDP, real GDP. I have told you about real and near. So this is. I'll just advise you that since you have solved the questions, you know what kind of questions are asked. So whatever is not required, you can simply delete it from the document, so that this document becomes a smaller and you can learn all the data. So the fiscal deficit, I've told you that currently we are running in fiscal deficit. There is a fiscal deficit target set. We should not be the fiscal deficit should not be 10% of the GDP, and we want it to reach in next 3 years. So these are taxation, certain things. Service tax is to be increased to 14%. So if you are eating outside in restaurant, it will be much more costlier. So gold monetization scheme, sovereign government bonds, gold coins. So all these things you can just see. Agriculture is maybe some questions may be asked. Industry and finance, banking and finance. Mudra Bank to be set to refinance microfinancing solution under PM's Mudra scheme. So you can just see this. Governance, social better, human resource, defense. So banking related, the current bank rate is 8.25%. Cash reserve ratio is 4%. SLR is 21.5%, right? So all these things I have here, and the changes. So I've just copied the data. Repo rate is 7.25%. Reverse repo rate is 6.25%. Marginal standing facility is 8.25%. Now here it is an important concept. National saving deposits is 4%, and saving deposit for resident, it's a deregulated thing. You can read it. Now this is important. Here I will spend some time. Two words: liquidity adjustment factor. Now liquidity adjustment factor is based on the amount of deposit a certain bank has with RBI. It can draw money from RBI. Okay. So LFA is a monetary policy which allows banks to borrow money through repurchase agreements, right? So an LAF is used to aid banks in adjusting the day-to-day mismatch in liquidity, right? So suppose a bank has deposited 100 crores, and according to the agreement, it can borrow 20 crores on a day-to-day basis with RBI, so that it can match its daily requirement of dispersing cash to people. Now suppose what happens is it has a limit of 10 crore rupees, and it wants 20 crore rupees. So there is a new policy which says that yes, you can borrow more than the original 10 crore rupees. So you can borrow 20 crore rupees, but at a higher rate. So that is what we call as marginal standing facility. Marginal standing facility is a new scheme announced by RBI, and it refers to the penal rate. Penal rate means higher rate, penalty rate, at which banks can borrow money from the central bank over and above what is available through a LAF window. LAF is this liquidity adjustment factor window. So these are the two terms, and just solve questions. Thank you.